Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. National Financial Literacy Month is celebrated in April, which is a great opportunity for us to check and promote our financial situation and skills. Joining me is Caleb Silver, Editor-in-Chief at Investopedia. And for this segment, we are going to discuss interest rates and the stock market. And Caleb, I can't think of another topic that's more prevalent or relevant for investors right now. Give us a background of how interest rates have performed over the last 30 years.
Interest rates have been pretty low for the past 20 years, but they're very important to watch. Now, everybody knows about the interest rate on their credit card or maybe their mortgage or their car loan, but interest rates, when we think of them, are those that are set by the Federal Reserve, our central bank, and that's the overnight lending rate, the borrowing rate, and a lot of the rates, like mortgages, like lending rates, are set off of that rate, and they've been low for a while.
So let's talk about some of the interest rate basics here, because they really do impact a number of touch points in our life.
Yeah, absolutely. They affect borrowing costs. So when interest rates are pretty low, consumers are more willing to borrow, to spend more money. Businesses are more willing to borrow, maybe expand, maybe hire more people, build more plants. So they affect the economy in a big way. That's why everybody is so keyed on what the central bank, our Federal Reserve, is saying about interest rates.
What are some of the common products that are impacted by interest rates?
Well, there's mortgages. They're not directly tied to the Fed funds rate, but they are loosely tied to it. So as those rates go up, you see mortgage rates rise, and we're already seeing that. Car loans are very similar in the same way. Credit cards as well. The APR you pay on your credit card can be greatly influenced by the federal funds interest rate. That's why we care so much about them.
And part of the volatility this year has been due to interest rates rising. On a historical basis, though, are we really at high rates?
Not at all. Talk to anybody that was around in the 1970s when interest rates were in the double digits. Those were very high rates. Mortgages were super expensive. It was hard to buy a home. Mortgage rates have been very low for very long. And at the beginning of the pandemic, the central bank, our Federal Reserve, set those interest rates almost 0%. So borrowing became very easy to stimulate the economy.
But as we were talking about, they are heading higher this year.
Interest rates are heading higher. They've already started, and they're probably going to head higher all year long. The Federal Reserve would like to see those around 2.5%, 2.4%. So the drumbeat of higher rates is coming, and those interest rates are already affecting, as I said, mortgages, student loans, credit card payments, and everything else.
How do low rates and high rates affect sectors differently?
Yeah, in the stock market, high rates generally mean that risk becomes something that investors want to steer a little bit away from, because companies that borrow a lot of money and are inherently risky, if they don't have a lot of profits and if things go south, they could be very risky propositions. So you see banks do well when interest rates rise. Why? Because they make money lending money, but you also see some cyclical stocks, some value stocks do well at the same time, less risky. Technology stocks and other stocks that are low on profits, they have a much harder time when rates rise.
How does one invest safely when interest rates are in flux?
Yeah, when they're in flux, especially when they're going up, you want to maybe pull back out of those riskier sectors and maybe think about financials or think about the sectors that do well when rates rise. And those could be, again, financial institutions, cyclical stocks, those that pay dividends. And when rates are falling, you want to be a little bit more aggressive because it becomes cheaper for companies to borrow money. So technology does very well when interest rates are low.
All right, Caleb, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.